You often hear about multi-chain or cross-chain in crypto. The idea of users being able to do things on multiple blockchains without any hassle for the user. Today we talk to Colton from Prime Protocol, an app that is leveraging cross-chain technical possibilities that the blockchain Moonbeam built on top of Polkadot provides. He is also a principal at a major venture capital firm called Arrington Capital, which has over $1 billion under management and has invested in hundreds of startups across the world. So we'll also chat about investing in crypto and what you can learn from them, the VCs. Stay tuned and follow us to catch this episode. All right, thank you for tuning into the Teach Me DeFi podcast for another episode. My name is Sohail, and today we got Colton on the show from Prime Protocol and Arrington Capital. Hey, man.
Hey, great to be here. Thanks for having me.
Good to have you here. I think this is going to be an interesting one. I mean, for one, you're a principal at Arrington Capital, if I'm not wrong, a known venture capital firm focused on crypto, and you founded Prime Protocol. So I think this gives us a bit of an opportunity to chat about many things, or both those things. We could explore the intersection of venture capital, investing, and the crypto space, but also what you're doing in DeFi with Prime Protocol. So what do you think? Is that a good plan?
Yeah, that's a great plan. Let's talk about all of it.
Sweet. Well, let's start off with you, sort of sitting in both those seats, right? You're a founder and part of a VC. I think that's an interesting combination. So you're kind of sitting on both sides of the table, the deal-making, investing side, but also the entrepreneurship side. Just tell me a bit about your background and how you ended up in those two seats and what that's like.
Yeah, so my background, I got into crypto originally late 2016, just as a retail investor, buying things like ETH. I bought Polkadot really early on as well. And I was also doing mining of like Monero and Zcash and a lot of those OG cryptos. I started building arbitrage bots to go between centralized exchanges back then, because that's really the only place these things traded, and liquidity was really thin. And back in early 2017, late 2016, even somewhat into 2018, that was still possible to make money there as a one-man shop. And so I did that for a bit. Then I went to college. I did econ research with the focus on crypto, looking at it from more of a traditional finance, like quant finance, asset pricing lens, writing. There were a couple papers that came out of that. I did that with a professor of mine who was also very into crypto. And then I got into traditional finance. I did summers at JP Morgan and Citadel. I went back to Citadel full time after grad, and I was doing quant work and trading work. I did interest rate volatility, which is basically betting. You're basically buying and selling options on the movement of interest rates. And that was a lot of fun. As a stats guy and an econ guy, there was definitely a lot to be interested in there. But I was still this whole time doing crypto in my free time. And after 2020, 2021, I had gotten really into DeFi. And that's what I was doing exclusively in my personal account. I was still doing that whenever I wasn't working. And eventually I got to the point where I was like, I really want to go and build something. And the thing that I wanted to build was from a pain point that I had, which was I had all of these DeFi strategies on different chains that I was running, and a lot of them involved leverage, but I couldn't cross margin any of them. And that was quite frustrating because that meant that I had to manage a ton of different liquidation levels. And that either meant that I was willing to take less leverage, or I was just taking more risk that I was going to get liquidated somewhere. And it would have been a lot smoother, both a better user experience, also a better, from a risk perspective, a better experience, and better financially to not have to pay swapping and bridging fees every time I wanted to move money around. To just have one global margining account, or one protocol that I could use to deposit and borrow from to run my strategies. And so that was the genesis for the idea behind Prime. So I started Prime and built it out. We launched about a year ago now. It's kind of crazy how time flies. On mainnet, and it's on 9+ chains now. We've got a couple more in the pipeline, and it's got a bunch of assets on it. We've also got more assets in the pipeline. So yeah, I think it's been a great ride doing Prime. And Arrington Capital is one of the original investors in Prime, and I got to know the team through building Prime and interacting with them. I thought they were one of the most helpful investors that I had. Also very supportive of the Moonbeam and Polkadot ecosystem, where I built the hub chain for Prime. And the opportunity came up to help them out with some diligence for some of the investments they were making. So I did that. That went really well. I ended up as a more permanent member of the team now. And it's been a fantastic time. Being on both sides also gives you a lot of perspective. It's been really interesting I think on the VC side, you get a ton of variety, which I really love. And it keeps you learning and keeps you abreast with what's going on in the ecosystem. And being on the entrepreneurship side, you have to go really deep into something. And there are a lot of like technical skills and things that you have to learn, which you don't really have a forcing function for if you're just working in VC. So that's how I got into where I'm at now, and I love it.
Right, that's cool. And you mentioned sort of like getting technical and getting more deep into things. In terms of building Prime, or perhaps even before that, when you were doing arbitrage strategies or other DeFi strategies on chain, and Prime, did you build that out yourself, like technically, or did you have a dev partner, or how did that look?
Yeah. I mean, Prime, there were multiple people on the team. It was a combination of me and other developers. So I focus mostly on the back end side. The front end is a little bit less my domain. And fortunately, there's another guy on the team who is fantastic, ex Netflix, who handles all the front end stuff. He also helps out on the back end. And I think it's been a great partnership throughout. And we've also had other developers on the team who we work with, and they're all pretty carefully vetted, and a lot of them have become good friends. So it takes multiple people to build out something like this.
Yeah, I figured. So in terms of how you started, did you start coding like some proof of concept version of it? Or are you self-taught in terms of that, or did you pretty much start as a team and build from there?
So I'm on the Solidity side, totally self-taught. I think that's how most people are. Like, they don't have a Solidity class in school. You just have to learn it on your own.
Yeah.
And for most of the coding stuff that I do, I'm self-taught. The only thing I think I learned in a class was C or C++, because for whatever reason, all of the Yale Comp Sci classes were in C. And maybe that's because they actually want you to understand how memory allocation works. But yeah, my main languages are Python, and now I've done a lot in Solidity, and all of that's been self-taught. And funnily enough, that's all I've ever used for work is Python, Solidity, some TypeScript, because we have to write a ton of tests, and that's what a lot of the front end is in. So yeah, and in terms of whether I built a MVP first, I started on building out an MVP. At the beginning, it was definitely a lot more me and less other people, because I didn't have the money to hire other developers. But as we built out the team, you sort of move into more of a product management role, and the percentage of your time that's spent writing code is going down, and you're doing more reviewing code, architecting, and then starting to work on biz dev once things are done.
I had a look at your website, and it says on there, deposit on any chain, borrow on all chains. I like the simplicity of this. It sort of was easy to understand pretty much immediately. Sounds like a clear vision. I just it's a bit of a contrast to what I usually see. These slogans and descriptions of apps and crypto are often a bit complicated when you take a look at their website. That's why I like to bring it up on the pod for a guest. Um, I just think, in a way, if you can't communicate clearly and simply what the heart of your product is and what it's useful for, then how much merit does it really have? Um, I don't know if I would invest in it necessarily. So I'm just curious if you could tell us more about that tagline, what's behind it.
Yeah, absolutely. That goes back to what I was explaining earlier with wanting a protocol where I could cross margin my accounts. So what that means is like I could deposit on, say, 3 different blockchains. Maybe I have AVAX token, I've got USDC on Arbitrum, and I've got ETH on Optimism. And I want all of those assets to back a borrow that I'm going to take out on Moonbeam in wrapped Bitcoin. And so what I can do is I can deposit on each of those chains individually. I don't have to go find a bridge. I don't have to wrap it and send it somewhere. I don't have to go through the whole research project of figuring out a borrowing protocol on Moonbeam that will take my collateral from these other chains. I can just deposit natively in each of those places, and then I can borrow on Moonbeam. And it's as easy as that. The protocol will then record all of those deposits that I had made, and then the borrow that it issues is backed by all 3 of those deposits combined. And that's the really beautiful thing about Prime and doing this cross chain, is that it looks at your account as a whole, not with each chain as its own siloed island.
Mm. And what do you need to do for that to be possible? Because that clearly sounds to me like a more truly cross-chain application, which kind of leverages communication between these different chains, and it unlocks a bit of a more capital efficient um, solution application. Are you deploying like different smart contracts on those different chains, and then the users interact with them?
Yep,
And
exactly. So there's a smart contract on each chain that we've deployed, and then they're all connected up by a generic message passer. So right now you can use Axelar for any of these transactions. You can use Layer 0 for some of them, and more of that support is coming as well. And what happens is we basically use a hub and spoke model for storing and distributing the information. So you've got one chain where after you make a deposit, there's a message sent to that chain, and it records the deposit amount or the borrow request, withdrawal request, or repay amount. And if it's something that needs permission, like a withdraw or a borrow, then it sends a message to whichever chain you requested the withdraw or borrow on. And then that chain distributes the tokens. And you do all your pricing and liquidity checks in one place because you don't want a bad actor to be able to spoof the network. And so you basically queue up each transaction and process them sequentially. So let's say you made all those deposits and then you requested 2 withdrawals at one time. Well, because we're forcing them all through one place, those withdrawals are going to be handled sequentially. So if the second one is too much after the first one that you did, given your outstanding borrow balance, it's not going to let it go through. And yeah, that's generally how it works. It's from the user perspective, you don't need to know which one's the hub chain or which ones are satellite chains, because they handle it for you, take care of the messages. You'll just notice a slight difference in latency depending on which one you're using.
And the hub for this is Moonbeam, right? The layer 1 blockchain on Polkadot.
Yeah, that's correct.
Are there unique characteristics of Moonbeam, technical possibilities by Moonbeam and Polkadot that make your app uniquely possible?
Yeah, so it ultimately depends on which message passers you're using and how you want to treat finality. But part of the problem with a lot of the L2s and using something like Axelar, which is going to wait for full finality, is that you have this period of time where you're waiting for the sequencer to publish to L1, and then L1 has to reach finality. And ETH L1 takes like 15 minutes to get to finality. It's really long time. And that means that the latency on any message that you're sending from an L2 somewhere else is going to take 15 to 20 minutes. And if we'd put a hub chain on one of these chains, it would have been quite painful for users. Every outgoing transaction having to wait for 15 to 20 minutes. And by putting it on a chain with faster time to finality, it really speeds up the process. The other things we wanted to be conscious of was this chain is also going to pass on gas costs to all of the users. And so we wanted to choose a chain that was reliably low gas. And at the time we were building this, blobs didn't exist. And so L2s looked like they could become significantly more expensive as ETH data availability continued to climb in demand. There were also some other chains like Avalanche that I had seen. Avalanche was another one that we looked at, but gas costs weren't necessarily reliable on Avalanche either. I had seen them really spike last bull market, and we needed something that was quite cheap, but also had that fast finality. And then we also wanted something that was EVM compatible, because that makes it a lot easier, at least for this version 1 that we're on right now, to deploy the contracts, to improve the user experience so you don't have to do any wallet binding and you can use the same wallet on any chain. And so Moonbeam was a great fit for all of that. The other thing that we liked was that the Polkadot community was very pro interoperability and really accepting of this kind of application and actively seeking out, like they call it, connected contracts to be deployed onto their chain. So we thought we'd get good support from the ecosystem. It satisfied the need for cheap block space with decent time to finality. And there's a bunch of other stuff Polkadot's doing with like elastic scaling that's going to make the block space even more available and prevent run-ups in gas costs. So those are the main reasons why we chose it. Ultimately, it was based on the infrastructure specs, and it seems like that fit the bill the best.
Right, that's amazing. And you mentioned cross-chain connected contracts. Is there more behind this, or is that sort of what you're doing with Axelar and these general messaging protocols?
That's exactly what I just explained. Where you've got contracts on different chains hooked up with these general message passers and sharing
and
information
Moonbeam as the
between
hub,
them.
so to say. Because I know it's a term that Moonbeam uses, and it's like a kind of use case they're pushing, I guess.
Yep, exactly. This is an example of that.
Right. That's cool. So basically your app is demonstrating one of these use cases that Moonbeam is pushing forward.
Yep. I would say so.
And what are you seeing in terms of users? Are they appreciating this easy usability, this kind of like cross-chain improved user experience for DeFi? You said, you developed it based on pain points that you were having yourself, right? Which is always, I think, a good start. So are you seeing this being appreciated and used?
Yeah, definitely. I think the only remaining there are a couple remaining pain points that we're working on fixing. I think one of them is that L2 finality that I mentioned. And while there's no way to get around full finality, there are ways where maybe you decide that once the sequencer is published to L1, that's good enough. And barring something, like if something really catastrophic did happen to an L2 and it went down, then maybe you're just losing all the funds there anyways, so it doesn't really matter. And I think the chance of that is so incredibly low that we're looking at ways where we can basically speed up those messages or have like market maker front that transaction for a small fee. And so getting the latency down on everything is a priority for us, including the transactions coming from non-hub chains. And I do think users really appreciate it. The use cases we've seen have been all over the place, but I think people do appreciate, one, not having to pay fees on these transfers. So if I want to do a bridge from, say, like ETH to Moonbeam, I'm paying a pretty hefty like bridge fee. There's some slippage I'm paying if I use something like a Squid router, which is fine if I'm going to be in that trade for a long time. But because a lot of these rates in crypto are variable, that's actually a pretty high fixed cost to be stomaching if I want to move into another ecosystem. Whereas on Prime, if you look at like the interest that you can borrow on some of these Moonbeam assets, if you're only in the trade for a few weeks, it's pretty negligible. So I think that's something that we've seen a lot of people do is basically like yield farming on a bunch of different chains. You can be in and out very quick, get your airdrop, get the high yield while it lasts, and you don't have to worry about upfront fixed costs. And then the other thing I've seen people use it for is the cross margining, which I mentioned earlier. So borrowing on one chain, but using assets from a bunch of chains to collateralize that borrow. So those have been a few of the use cases.
Right. So if I'd have, let's say, I don't know, ETH on Arbitrum, USDC on Optimism, and I'd like to borrow DOT on Polkadot, would I be able to use those two assets as collateral for that DOT loan on Prime?
Yep, exactly.
Okay.
That's totally
Well,
possible.
that's pretty handy. Are you seeing any other apps that are doing this, or is this like the first what you're doing? Or I mean, there's a lot of lending protocols, right? Have they started doing similar things as well?
I haven't seen any as far as along as we are. There are some that are now exploring the idea, and there have also been others that have tried it in different flavors. Like there was Umi, which was doing, they had a Cosmos app chain and we're doing cross-chain borrowing between Umi and Ethereum. There was Radiant Capital, which has said that they're going to do something like this. They haven't done it yet. They've mostly focused on their tokenomics design first and a couple single chain deployments, but maybe they'll do it in the future. I think what's challenging is it's really hard to start out as like a single chain lending protocol and then back into a truly cross-chain, cross-margin protocol because you can't start with a compounder Aave fork and get here. That was something I initially looked at when I started building Prime was, is there any way for me to fork code and just make a couple changes? And the answer was no. It's actually a lot more complicated than that. And that's why it took us a little bit longer to build. We also made some pivots to the original design. So yeah, there aren't too many other protocols out there. There's also a couple other nascent ones I've seen that are doing maybe something similar where they're basically aggregating USDC on one chain and then distributing it using CCTP, which recently became available. And that's an interesting approach. I think the difference between us and those other protocols is your flexibility on like assets that you take is going to be a lot lower using their approach, but you're going to solve some like fragmented liquidity issues. So yeah, I feel good about where we're at in the market right now. And I think we do have a good advantage on people in terms of having the tech out there for a while and making sure it's been proven.
So can you share a few metrics? I mean, it's DeFi. Everyone loves to talk about TVL, although it has its shortcomings. TVL. And also, I'm actually not sure. Do you guys have a token, things like that?
Yes, we don't have a token. We're running a points program right now. And I can't explicitly say what the points program is, except for it to basically track our early users' engagement and have a metric for scoring that.
Right.
But I think we have publicly announced that we are planning on doing a token, and it's going to be coming soon. So once that token is live, we'll be able to do all the things that you expect from a token, like start implementing some decentralized governance, use it to help incentivize markets, and a whole host of other different utilities that we'll give to token holders. And I think once the token is out as well, that provides another like more direct way to help grow the protocol. In terms of TVL, now there's more and more crypto that's in the protocol and less USDC, because it seems like people don't want to deposit USDC, but they do want to deposit crypto now, which is the
Oh, okay.
opposite from the bear market, where everybody
Yeah.
wanted to deposit USDC, but nobody wanted to hold Bitcoin and ETH.
Hmm.
And so it bounces around depending on like where the market's at. I think recently it was around 10 million. It's gone as high as 15. There's been a lot of activity in and out of people like borrowing, repaying, moving their funds around, which is great to see. We have a lot of active users, and when we launched a year ago, it was 1 million or less, and it's been all unincentivized by our own token. So
Hmm.
like most of the TVL is not on a market with a token drip. We do have a grant from Moonbeam, so there are some pretty juicy yields for especially stable coins on Moonbeam. But
Hmm.
outside of that, we still have some high yields elsewhere, and it's all organic, which is, I think, really bullish, because once we have the token out, there's really no limit to how high this thing can go.
Hmm. Are those juicy yields you mentioned paid out in Glimmer or as Moonbeam's token, or in what token?
Yes, Glimmer, and also the native token that you deposit, depending on the demand for that market.
That part comes from basically uh, the actual demand, right? Like
Yeah,
the borrowing.
yeah. I mean, as we speak, if you go to like the USDT market on Moonbeam, you can earn a combined like 33% on your USDT, which is pretty decent for a stable coin. And if that's not even counting the looping yields that you could get by borrowing USDT or USDC on a different chain, sending it over and looping that.
Mm, right, and it's without the native token of the protocol, like because you don't have one yet. So it can't be basically it's not blown up by inflating it with a token that's being printed. Of
Exactly.
course, there's the grant, the Glimmer grant, but still.
Yeah. Well, we've seen high yields on other chains too. Like right now, you can earn a native 24% on your Polygon
Mm,
USDC, and that's totally unincentivized.
mm.
So that's all paid out in USDC.
Cool. And I think there's something else you do around gas fees, which is interesting. I think you call it universal access. Can you
Yep.
speak about that?
So what we do with gas is, because the way the protocol works is you're sending a message from the chain where you initiate a transaction to the hub chain, and then the hub chain sends a message to the final destination chain where tokens are released. That initial call can be done from anywhere if you're doing a withdrawal or a borrow. And so what we call universal access means that you can choose whichever chain you want to pay gas on, whether, like, let's say you want to take out a borrow on Polygon. You could pay that gas in Matic if you want, but maybe you're already on Moonbeam and you want to benefit from the better latency of Moonbeam's faster finality. You could pay gas for that borrow on Moonbeam, and then we only have to send one message from Moonbeam to Polygon, and then you get your funds more quickly with lower fees. And so we enabled that for users, and we find that it's actually quite common that people will use gas on a different chain than the one where they want to receive tokens. The other thing that this is really useful for is, let's say I want to start doing something on Polygon, or I want to start doing something on Arbitrum, but I don't actually have any gas there. Uh, if you had a cross-chain lending protocol that just gave you USDC, then that's kind of useless, because you need to figure out how to send gas over there.
Mm.
But what we can do is we can let you borrow the gas, and you can submit that transaction from any of the other blockchains. And so that's also really useful, helping to onboard people to new ecosystems.
Right. Borrow the gas. So what is it? Just a little bit of dust, so to say, to be able to pay gas fees, or?
You can choose however much you want.
All right. And then you have to pay it back on the destination chain?
Yes, you have to pay it back wherever you borrowed it. So if you borrowed like Glimmer token, you'd have to pay that back on Moonbeam's chain. If you borrowed AVAX, you'd have to pay that back on Avalanche.
Okay. And is that something that could be also interesting, like paying it back in dollar value in whatever coin you like?
We could implement that in the future, and all we would do is we just have you do a swap on whichever is like the preferred DEX before you pay it back. But ultimately, you'd still end up paying the same swap fees and slippage as if you went to the DEX directly. We can't offer you cost savings there. Ultimately, it does have to get paid back in the currency that you borrowed it in because somebody else deposited that token and is
Yeah,
expecting to be able to withdraw the full amount.
right. I guess it would just be like a convenience sort of thing.
Yeah.
Yeah,
Yep.
cool. Yeah, let's switch to the VC side of things, if you like. Tell us a bit about your role at Arrington Capital. I believe Arrington Capital is like a major VC. I think over 1 billion in fund size, invests in all kinds of startups and early stage companies. So yeah, just tell us a bit more about what you're doing there. You mentioned you work on due diligences and things like that. Yeah.
Yes, Arrington Capital it's a Web3 hedge fund. There are liquid strategies and there are private investment strategies. And I mostly focus on looking at new deals that are coming in. The firm is set up, even though it's quite big in terms of AUM, to look at the earliest stage deals, like seed, pre-seed, and we'll do later stage as well. But I think the most exciting time to invest in a company is early on in its journey when there's a big blank canvas and a lot of opportunity. And the firm is focused on finding exceptional founders. And that's the most important thing when picking an investment. And then also investing in great ideas and great technology. And my role there, I find new companies, I research them, look into the market opportunity, talk with the founders to get a sense of how they work, and help make investment decisions ultimately. I'm also available to help with our companies. I've even done some. We're working on some integrations with Prime and some of our existing portfolio companies, which has been really fun to see that collaboration. And we also, in addition to me, have other people on the team who are very good at Portco support and helping them be successful. So it's really the whole life cycle. I focus mostly on the beginning parts of finding the good ones and figuring out which ones we want to work with. But we have people for the entire life cycle of making sure that you can get good PR placement, helping you get connected to the other portcos in the 200 plus portfolio that we have, and ultimately helping you, make it to the point where you're live, you're on mainnet, you're successful, you have a liquid thriving token, and at every step along the way, I think Arrington's able to help a lot with.
Right. What has that been like? Is it a nice learning experience to be able to see it from the VC side as well? And like, what are you enjoying most about what you do?
Yeah, it's absolutely a learning experience. And I think that's actually what I do enjoy most is it forces me to continuously learn about all these different areas of crypto and keeps you sharp. And I think that's a lot of fun. There's a lot of variety because Arrington Capital is a more generalist crypto investor. And what I mean by that is their investments in infra and in DeFi and in gaming. Whereas some investors might focus just on gaming, or some investors might focus just on DeFi or just on certain parts of infrastructure. At this point, infrastructure doesn't really mean anything because it's so broad.
Yeah.
Or maybe they're just focusing on AI and crypto or just NFTs. I know some investors that do that. And I think once your fund gets up to a certain size, you have the blessing and the curse of needing to invest in everything. And I think the blessing of that is you get maximum optionality, maximum flexibility, and you can also think about an ecosystem holistically because there are a lot of different things that a crypto ecosystem needs to thrive. It needs a good DeFi ecosystem, but gaming is becoming increasingly important in crypto. And gaming relies on DeFi because eventually those tokens need to get listed in the DeFi protocols to make them liquid. It also relies on an NFT ecosystem because you might have in-game NFTs. You'll have real-world assets, and there's companies to back that are doing the tokenization of those assets. There's DeFi protocols that are integrating them, and we might do some of that on Prime as well. And so there's a lot of synergies between these different parts of crypto. And I think that's also what makes it really exciting, is how everything is so composable that being able to invest in each part of the stack gives you full view into what's going on and how an ecosystem is likely to evolve, and then how you can help it move further.
Right. Okay. So you got more of a holistic approach. That's interesting. Be that as it may, are there key trends or sectors within crypto and Web3 that you're currently most bullish on?
Sure. I'm bullish on a lot of sectors, and I don't think there's going to be one sector in crypto that necessarily wins out. I think there's the ones that are currently hot that everybody's excited about, like AI. There's a lot of opportunity. I also think there's a lot of hype in the AI ecosystem that's maybe trading more like a meme coin than relative to the fundamental value of the protocol that's underlying it. And so if you're investing in there, also, even as a retail investor, if you're buying liquid tokens, you just have to be careful and recognize that at least in the short term, your returns are driven by this meme coin like mentality. In the long term, your returns will be driven by investing in valuable projects. We're also still investing in DeFi. I think DeFi is cornerstone of every crypto ecosystem, and you've got to have it. Ultimately, that's one of the main use cases of a blockchain, is having an open ledger and means of transacting with other people and sending value back and forth in a low friction way. And then I also think that there's a lot of excitement around the Eigen ecosystem, and we've invested in liquid staking protocol, multiple AVSs now, and we're looking at more solutions that leverage Eigen, which I think is a big breakthrough in how you bootstrap security for your network. I think app chains are awesome, but it doesn't make sense for everybody to have to worry about their own security. And having to bootstrap that themselves with a native token, there are a lot of drawbacks. It's also very onerous on the network, can cost a lot of inflation. And we've seen a lot of projects fail as well because they didn't make it through the bear market because their token value fell so much. And so I think Eigen is a great innovation to help address that. And there's a lot of new projects that are being enabled by this that weren't previously possible. So we're looking at that very closely. There's also a bunch of other restaking protocols that are popping up using things other than ETH. We haven't invested in one yet, but I think it's an interesting concept. And that's the other cool thing about crypto, is people are just running tons of experiments, and some will work, some won't. And I think that's actually really healthy for the ecosystem, is you're basically speed running all of this innovation. And then something else that I mentioned earlier that we're quite bullish on is the gaming ecosystem. Arrington, big supporters of IMX, have been supporters from the very beginning. And that whole ecosystem we think is really taking off. There's literally billions of gamers in the world. And I think it's a great way to onboard people onto crypto. And if you're able to do it in a way that's seamless and they don't realize they're using crypto at first, but then you give them that option to start getting a taste of it, and then you bring them into the DeFi ecosystem and the real world asset ecosystem and make them more of an on-chain native, I think gaming is a great way to do that. And so we've invested not just in the infrastructure level via IMX, but now we're also starting to invest in a lot of these IMX-based games. And I think there's a lot of really cool ones in the pipeline that we're very excited about. And we've also invested in some existing ones. There was a recent announcement that we did Illuvium in their most recent round. And I think it's not just IMX too. Like, every ecosystem now has games that are starting to be built on it. And I think that there will be a big Cambrian explosion of that as well.
Yeah. All right. Just wondering, in terms of, infrastructure seems more straightforward to me in terms of the investment thesis. When you invest into specific games, you take on kind of different level of specific risk tied to that game,
Yep.
right? So I'm just wondering, let's take Illuvium as an example. What drove that decision to invest there? And I know that's a game that's been, I don't know if the game has been around for long. I'm not sure to what extent they launched actually, but I know the token has been around for some time. Yeah, just can you give some insights into what drove that maybe?
Yeah, well, Illuvium is coming out. They now have, so they have a few different games within their ecosystem. They have like brawler. They have more of like an RPG style game. They've got a sort of like a farming. I think it's called Illuvium Zero, kind of Clash of Clans experience. And so they have all these different things that you can do within their ecosystem. And one of the things that we saw was there's a ton of engagement so far with their NFTs. People buying plots of land in their world, trading a bunch of these in-game NFTs. And the games that they have out so far have gotten great traction. And the new ones that they were launching, we took a look at, and we think they just look like a lot of fun. And ultimately, it's about, I think, like gaming, you have to capture a lot of attention, which Illuvium has done successfully. And you can see that in the volumes of their NFT transactions, the amount of people who have signed up for the wait lists for the games that hadn't launched yet, and for the ones that had launched, the number of people who had tried it out. You can also see it in the retention of people who are playing the games. And all of that looked very strong for them. And there's also sort of a power law to how these games end up playing out, I think. And so if you get a really top tier game that has top tier developers and a lot of resources that went into it, that sort of success begets more success. I think in the case of Illuvium, they have done a very good job of really investing in a beautiful experience with a set of like very immersive worlds and very intuitive gameplay, whether it's their like brawler and their battle arena, or like Illuvium Zero, or even just down to like the artwork in their NFTs. So I think just looking for like signals of high quality at every step of the way is really important. And you're right that you are taking on a higher level of idiosyncratic risk with these games. And we've invested in multiple of them. And that's also part of the risk that you have to take on in venture, is investing in things that do have some idiosyncratic risk. You invest in a few of them and you try and do as good a job as you can. We think that all of the ones that we've invested in are going to do incredibly well. I'd be surprised if any of them flopped. But that is the risk that we're taking on. And that's also why prices are lower as you go earlier on in venture. And you're compensated for taking that extra risk.
Yeah. When you say you invested in Illuvium, I'm just trying to put myself into the shoes of viewers right now. Maybe they hear that and they're like, oh, I got to buy that token. When you say you invested in Illuvium, is that, I mean, the token is liquid and on the market, but I assume you didn't like buy it on the market. You maybe made a deal that's not disclosed with the foundation or whatever behind Illuvium. And perhaps it wasn't even for the price that the token is traded on the market. Just trying to get some more nuance on this for people listening and perhaps making.
Yeah, so these kinds of deals can go a ton of different ways. You can either buy tokens direct from the foundation, and sometimes that's done because the foundation wants more cash without having to go sell tokens on the open market. So you're basically absorbing that demand. Sometimes the price is actually close to the market price if there's not that much liquidity, but you do want to build a position. There's also situations where you'll be purchasing actual equity in the company, and maybe the company's equity has tokens on their balance sheet, and that's how you're getting exposure. So there's a lot of different structures that can happen. It doesn't necessarily, and sometimes like we do buy tokens on the open market as well. And we have done that for games in particular. We've said, hey, like the private deal that they're offering in this next round, we actually don't think is as good as just buying the token on the open market. And because a lot of times, like anytime you do a private deal, whether it's equity or buying tokens, there's going to be some kind of lockup that you're restricted to. If it's equity, then it's kind of enforced by the company that has the tokens on the balance sheet. And if it's tokens directly, then it's a lockup that was agreed to by the company or foundation and the fund. And so having that flexibility sometimes is preferable. And so we've done both, and we've done every flavor of this. It usually just works out to the ultimate goal is the foundation or the company has a new initiative. They need more funding for it. We find a way to do that that has as little adverse effect on the token price as possible. And I think a lot of people have this misconception that VCs are just in it for a quick pump and dump and it's trying to wreck people. And we actually take like a lot of care that if we ever do choose to take liquidity, we do it in a way that is as minimally impactful to the company as possible, because we have large positions in these things and we're never selling everything at once. And so if we impact the token price negatively, that impacts us too. And like maybe more than you would expect. And so a lot of these positions are like core long-term positions for us. And we really only invest in projects that we think are going to be around for many years to come, because we're not going to be exiting the entire position each cycle, right? I think some VCs, they try and make sure that they're below like 1% or so of ownership in any given project so they can easily get out. And we take, because we invest early stage, we have pretty meaningful ownership in a lot of these things. And so, yeah, it's usually pretty helpful for the companies as well. They'll come to us because they know that we already have such a big stake in them. If they're doing another deal with us, we're incentivized to make sure that the project is long-term successful.
Mm. Do you engage in governance? I know there's been a few debates in the past. I think it was on some sort of DeFi protocol on Ethereum, where VCs, I think maybe it was A16Z, was voting with substantial amount of tokens to favor some sort of proposal, which I think would have
thinking about Layer 0 versus Wormhole or Axelar.
Yeah. And wasn't it that I think, and correct me if I'm wrong, it was something like they were voting that some other protocol or something is integrated and they had some sort of stake in that other tokens protocol.
Right. Well, so A16Z invested a lot into Layer 0. It's a huge position for them. And I think they voted for Layer 0 to be the basically governance bridge for Uniswap or some other large protocol that was deploying cross-chain. And yeah, I think that's obviously not great if they're just voting to try and boost their bags. We will participate in governance if it's helpful to the ecosystem. We are more participating in governance. I actually think it is helpful for a lot of protocols when we do participate in governance, because most governance proposals are not that. A lot of governance proposals are, we have a actually decentralized network, but we need to do an upgrade that has been proposed by some of the core devs. And if we don't reach a quorum, we're not going to be able to put the upgrade through. So we've had companies, and maybe sometimes this even involves like a security upgrade. We've had companies call us at odd hours and say, hey, this would be really helpful to us if you guys could help us put this through. And we pride ourselves on responding very quickly and being active there. I think what we try not to do is get involved in that kind of politics where we're like doing something that is like very controversial in the community. In that case, we're either going to delegate our votes to other like respected community members and sort of let them make the final decision. So there's no like conflict of interest coming from us, if that is something to be considered. And I think we do try and we want to be good at community members and ecosystem participants. And so when we are participating directly in governance, it's always with an eye towards helping the projects as much as possible. And when we have large stakes in projects, I think usually values are aligned there. The A16Z case, I think, is kind of a one-off where there was a clear conflict. But normally, I think the incentives are in the right place.
Yeah. Okay. No, I think generally it's a good thing to be active, right? And actually use the protocols and interact with them as an investor. And you probably should have more of it, but that's interesting to hear that you participate in governance when it can help the ecosystem. Another thing I wanted to talk to you about was, I have a background in M&A, so mergers and acquisitions, valuations of companies, closing deals to buy companies, and so on. So quantitative analysis seems a bit hard to me for early stage investing in general, because the venture doesn't have any history yet, no historic financials that you can extrapolate into the future. But in crypto, it's especially tricky, I find, because we don't even have a grasp on the right success metrics yet. Like, for example, number of wallets does not equal unique users. Most protocols do not generate any significant revenue yet and survive on inflation. TVL can be problematic as a singular dimension. At the same time, there's so many projects launching, seeking funding, and so much of it is vaporware or blatant scams, copy pasta, So how does Arrington Capital approach this to find the right projects to invest in? Like, what's your criteria? How do you ever arrive at a valuation then to make it concrete, given that there's so little quantitative data to go on?
Well, I'd say the most important thing is that it's a solid founding team and that they're in it for the right reasons and they're not in it for a quick pump and dump. I was on a call one time where somebody literally said, like, this is like, we know the drill. We're going to get you liquidity within a year. We know how to do the pump and dump. And he literally said that on a call. And this was for, I won't say which protocol, but a project launching on a new high profile chain that you would probably expect this kind of behavior on. Is people like to launch when there's a new chain that comes out. A lot of the first movers they're building things with kind of shoddy security practices, launching a token very early, trying to build hype, and then dump on people who are aping in without really doing a whole lot of research into who's behind the project. And so we obviously passed on that. And
was that actually like a known protocol?
I'm not sure how successful they are right now, but they were raising it, I thought, a high valuation, and they had some like big investors in it.
All right.
So like it does happen, unfortunately. And I think it's unfortunate that happens in our industry, and the best thing we can do is just not participate. There's not like, and I think to basically spread awareness of which projects we think are solid long-term investments, and that's something that we're going to do more of an effort to do, as well as maybe put out some research outlining fundamental case for these different kinds of protocols and why their adoption will continue to increase, maybe how that ties back to things like long-term revenue. But you're right, it is really hard to predict, because the thing about crypto, and I think why some of these high valuations may be justified, is your growth rate can be so high in crypto relative to anything that we've seen in traditional markets, that if you think about like your traditional DCF, your cash flows are so backweighted and your growth rate is so high that you could actually end up with a pretty decent valuation if you end up on that growth trajectory. So that's one way to think about it. But ultimately, people aren't really making valuation decisions based on like some fundamental cash flow analysis. A lot of it's just supply and demand and where the market clears at. And after you've invested in enough of these, you sort of get a sense for, okay, if they receive X amount of traction, we probably expect the token to launch somewhere in this range. Maybe that range is super broad, But if you're investing below where you think that ultimate outcome is going to be, then you'll make money. And I think you could also look at it from a, like when you invest in ETH, you don't actually have a fundamental model of like exactly where ETH should be priced. And anybody who tells you they have a crystal ball that's predicting exactly like what the fundamental value of ETH is right now is lying to you. What you can say is, I see a bunch of structural flows that are going to push ETH up for X, Y, and Z reasons. There's also a lot of like positive activity that's going to continue to drive demand for ETH. And maybe that ties into a couple of these flows. And as a result, I want to be long. And so you can make an educated and informed decision with an investment and be directionally correct, even if you don't have a like specific like spreadsheet with every detail figured out for a seed stage investment, which is never going to happen. And even in traditional venture capital, if you're trying to model something out that way, you're making a lot of assumptions. And in quant finance, a common term that people use is like garbage in, garbage out. And that's also, I guess, in machine learning, another saying. If your model has bad assumptions, then the output is totally meaningless. And so I think the real art of doing, especially early stage investing, is being good at making those assumptions and being right when you're right in a big asymmetric way. You don't even have to be right more often than you're wrong. You just have to be, when you're right, really be right in a big way. And so that's, I think, a lot of also what you look for is like asymmetries. So companies that have very high upside relative to the downside potential, and making sure that that's always present in the investments you're making.
Okay. So yeah, it's not really like the case that you would be running models, calculations, DCF or whatever. It's mostly qualitative data, making sure the investment thesis makes sense, the quality and track record of the team, perhaps early successes or proof of concepts.
Yeah, for an early stage company, that's all you have.
Right. Do you actually also like analyze the code base? Do you have a tech team that does that or something like that?
Yeah, I've taken a look at many code bases for companies that we're investing in.
Okay. Perhaps to wrap this up in terms of the VC side of things, and this has been really interesting, I think. Maybe to make that kind of connection to viewers again. There's probably many viewers, probably most of them, that are invested in crypto, right? So I'm just wondering if there's things to learn from VCs. You already mentioned things that I think were interesting and went into that direction, but obviously retail investing is very different. But still, are there any mental models or ways of thinking at Arrington Capital to guide investment decisions? Like, do we invest, do we not invest, or something like, is this the right time or not the right time? Is the market too hot? Are valuations too high? Are VCs getting too reckless and funding everything, which we have seen in the past, and they're not doing their due diligence? They're just looking who else is on the ticket, can you just tell us?
I would say there are definitely things starting to get funded now, which are funding rounds that are driven by FOMO. And VCs have they have the same human nature that retail investors do. They're just investing at an earlier stage with higher risk and higher reward. There's also still a ton of money to be made in retail investing, and that's why Arrington Capital has a liquid fund. We're doing a lot of the same stuff that a retail investor could do as well. I think the places where we've been the most successful and where you make the most money are when you build conviction around a project, it's a real project, and you hold it for the long term. Trying to time the market, especially as a retail investor when it's not your full-time job, is really hard because there are a lot of factors that go into that. There's idiosyncratic factors, there's macro factors, there's the broader crypto market, there's the amount of leverage in the system. And a lot of these things we're able to look at, and we have a team that's doing this full time. And so we can do some timing of the market, and very strategically, we're able to make some money there by basically overlaying alpha on top of a predominantly long strategy. But ultimately, my advice to a retail investor who's wondering how to make money in crypto is find projects that you believe in long term, that is growing its user base, that has real projects being built on it, or is a real project with real users that you think is going to continue to grow and be useful over the long term, and invest in that. And the best way to do it is think about if this was the top of the bull market and everything went down today, am I going to have a little bit of dry powder left to basically buy the dip and invest in the bear market? And so I would say, like, you always want to keep a moon bag, but you also want to keep a little bit off the table so that you have some dry powder in case things go sideways. And by sort of moving slowly and making sure that you're positioned well for any market scenario, I think is important, because you're never going to time it perfectly, and almost nobody does. And when you do, it's mostly luck. There are people who have a lot more resources than you who are trying to do the same thing. And my best trades were when I bought Ethereum back in 2016. That was by far the best trade that I've made. And I held it until 3,500 in 2021 and sold it there. And then I bought back in, and I'm still holding. So, and then there are a bunch of other tokens that I did really well on over a short period of time. And I fully recognize that was gambling, which I think is fun. And there's nothing wrong with a good meme coin. I love meme coin investing as well, but you just have to recognize, like, what you're doing is gambling to some extent. And if you're trying to build long-term wealth, you shouldn't put all your eggs in that basket.
Yeah. So best to be honest to yourself and manage your risk based on that honesty. Well, that took a lot of conviction to hold Ethereum that long until it reached that price. And from what it sounds like to me at Arrington, you kind of value asymmetric risk reward opportunities and projects in crypto being able, just because of the structure of the market and this technology, to hit a growth trajectory which can be quite exponential, and then making long-term bets.
Yep. Yeah, exactly. You want to make long-term bets. You want to buy things that are going to survive over multiple cycles, because you don't know how long the cycle is going to be. And even if you do think external circumstances could change, and people update their expectations all the time, and you need to be ready to admit either I was wrong or I received new information and it's time to make a change. And so once you do realize that you need to make a change in your portfolio, it's okay to take some tax write-offs and move into the thing or opportunity that you've identified that is better. Just don't do that too often, or you end up getting chopped up.
Right. Sweet. Cool, Colton. Thank you so much. That was really interesting. How would you like to wrap this up? Anything to point viewers to in terms of Prime Protocol or Arrington Capital, or if any founders are watching and want to raise funds, anything like that?
Well, on the Prime side, definitely go check out app.primeprotocol.xyz, and you can start using Prime today and earn points, in addition to all of the great yields that I was talking about. And those are fluctuating, so make sure to check back periodically to see when they're going up. On the social side, follow Prime_protocol on Twitter. You can follow me personally at Colton F. Conley. And on the Arrington side, if you are looking to raise money, Arrington is very actively investing. You can DM me on Twitter or shoot an email to deals@arringtoncapital.com. And we'd love to take a look at your deck. On the Prime side, if you want to integrate with us, if you want to get your collateral listed, also feel free to reach out. We're actively looking for new partners and expanding on that side.
Sweet. Well, when you reach out, just don't mention any pump and dumps, and you'll be golden, I'd say.
Exactly.
Sweet. Thank you, Colton.
Thank you.